Here's a situation that plays out more than you'd think. Business owner is setting up a new company. They sit down with their attorney and their CPA. The attorney says, set it up as a partnership, best liability protection. CPA says, set it up as an S-Corp, least income taxes during operations. And both of them are right from their own perspective. But nobody asked, what's the exit plan? And what does that mean for which entity you should use today? I'm Matt Losanno with Cinder Wealth. Today we're going to do a plain English breakdown of LLCs, S-Corps, and C-Corps. What each one means, when each one makes sense, and why your entity choice today can have a massive impact on your tax bill when you eventually exit. Let's start with a simple breakdown of the three main options. An LLC is flexible. It gives you liability protection, a legal wall between your personal assets and your business. And by default, it's taxed as a pass-through, meaning the business income flows to your personal tax return. LLCs have no restrictions on how many owners you can have or what type they are. They're simple to set up and manage. An S-Corp is also a pass-through entity. Profits and losses flow to the owner's personal returns. But here's the key advantage. S-Corp owners who work in the business can split their income between a salary and distributions. Distributions aren't subject to payroll tax, so done correctly, this can save you real money. The catch? S-Corps can only have 100 shareholders, and all of them must be U.S. citizens or residents. And there's only one class of stock allowed, though it does allow both voting and non-voting shares for that class of stock. A C-Corp is taxed differently. The company pays corporate tax at a flat 21% rate as of today. If you then take money out as dividends, you pay tax again on your personal return, what people call double taxation. But here's why C-Corps matter for business owners. They're the only entity structure that qualifies for qualified small business stock treatment under Section 1202, and that could be enormously valuable if you're planning to sell. Let me explain QSBS, because this is the one most business owners have never heard of, and it might be the most valuable provision in the tax code for people planning to sell. Qualified small business stock, Section 1202 of the tax code. Here's how it generally works. If your company qualifies as a C corporation and meets the QSBS requirements, and you hold the shares for at least 5 years, each eligible shareholder may be able to exclude up to $10 million of capital gains from federal tax when they sell. $10 million per person, tax-free at the federal level. I had a client setting up a business they thought could be worth $50 million in 5 years. Instead of the S-Corp or partnership the advisors recommended, we structured it as a C-Corp. Then we made the husband, wife, brother, and brother's wife all shareholders. 4 people, 4 $10 million exclusions. That's potentially $40 million in capital gains they wouldn't pay federal taxes on when they sell. If they'd gone S-Corp or partnership, that benefit disappears entirely. There are real requirements. The company must be a C corporation. You have to acquire the shares at the original issuance and hold them for at least 5 years. The business must be actively operating as a qualified trade or business, and the company's gross assets can exceed $50 million at the time the shares are issued. This isn't the right strategy for everyone, but for a business owner with a 5-year exit horizon, it's absolutely worth evaluating with your CPA. So, when does each structure make the most sense? Start with an LLC if you're a new business, you have a small number of owners, or your exit strategy isn't defined yet, and you want flexibility. An LLC can elect S-Corp tax treatment without changing the legal entity. An S-Corp makes sense if you're profitable, you work in the business, and you want to reduce payroll taxes on part of your income. S-Corps are a great middle ground for owners making $300,000 to $700,000 who aren't planning a near-term sale. Consider a C-Corp, though, if you're planning to sell in 5 or more years and think the business could be worth significantly more at exit. The QSBS potential is often worth accepting the C-Corp tax structure during operations. Here's what many people don't realize. Your tax classification can change over time. An LLC can elect to be taxed as an S-Corp, and a business can later become a C-Corp. But those transitions have tax implications and timing rules that need to be planned carefully with your team. The earlier you plan, the more flexibility you have. I want to come back to something I said at the beginning. Your attorney recommends an entity for liability reasons. Your CPA recommends them for tax efficiency during operations. Your financial advisor is thinking about how you exit and what it means for your wealth after the sale. These are 3 different lenses. And if all 3 advisors aren't in the same room or at least on the same call, you end up with a structure that serves one goal at the expense of the others. The tax code is actually designed with business owners in mind. The QSBS provision, the ability to use retirement plans like cash balance plans inside your business, the way estate planning interacts with business ownership. But these things only work when they're coordinated, and coordination only happens when someone is making it happen. That's the gap I see most often. Not bad advisors, but isolated advisors, each doing their piece. Nobody connecting the dots. Here's what I want you to walk away with today. Your entity structure is not a set it and forget it decision. As your business grows, as your goals change, as you get closer to an exit, the right structure can change too. If you set up your LLC or S-Corp 5 years ago and haven't revisited it, it might be worth a conversation with your CPA and attorney, especially if you're starting to think about what an exit looks like. I'm Matt Losanno with Cinder Wealth. Subscribe for more content on tax strategies, exit planning, and wealth coordination for business owners. Thanks so much for watching.